Hi, all. I'm going to just talk for a little bit on intro while people sign in right now, but I am so thrilled to be here. I've been trying to get in with OCAR for a bit. I know it's been a challenge with COVID. We were just discussing that. So thank you for being here. I know our days get busy, especially in beautiful summer weather that we're getting. So my name is Kayla Ferking. I'm a division manager with Asset Preservation Incorporated, also known as API. We love our acronyms in real estate, so there's another one for you. API is a national 1031 exchange accommodator. That gives us a little bit of a leg up on competition because we have our Eastern Regional Office in New York and we have our headquarters in Roseville, California. So we kind of balance out, if you're familiar with the tax code, the identification, we can extend a few hours given our timeline and timestamps. And especially with reverses, we have a larger capability and an exchange accommodation title holder in-house with our great legal team and counsel. Now, myself personally, I've had my real estate license for almost 13 years now. Gosh, like doing the math, almost 13 years now, and I've been with API for almost 5. Before that, I was in your shoes. I absolutely love real estate. I was born and bred into a real estate family. So if there is a question that you have as we go through today, please put that in the Q&A. Let me know. I'm going to review a little bit of the 1031 exchange tax structure first. Okay, for those of you who aren't super versed on it, we'll spend about 5 to 10 minutes. I'll take a break for questions, and then we'll go into 9 different various pitfalls. And what that means is what you need to avoid or really know and be ahead of the game as a realtor when you come into this transaction category of a 1031 and you're baffled, right? So let's get ahead of the game here and cover that. Now, starting today, as we move along in this presentation, I do have to put a disclaimer up. We do not give legal tax advice. So that's a big one to note and a takeaway. Any qualified intermediary, make sure that they're not giving your client legal tax advice. They should be going to their CPA or financial advisor for that. Some recent trends that we have seen, and especially from my position, we've seen all of these people exchanging out of their downtown sky rises, their condos, in Irvine, it's downtown San Diego, where I cover Orange County and San Diego, and they're moving into the suburbs. So they're holding long-term investment property in the exchange realm and wanting those long-term tenants for families to move into their property. We have less demand for multifamily property, again, more outside of the urban core. And a lot of the states in this bottom bullet point that I have here, the big ones that I'm seeing: Wyoming, Tennessee, Florida, Texas. I think we all saw Idaho was a big one the last couple years as well, and that market is sky high. So this slide is really to declare for you and a takeaway that our exchange trends always piggyback off the residential real estate market. Granted, a 1031 exchange covers investment, real property, right? So it could be commercial and residential, really anything held for investment. We have a little bit I want to cover today. This is coming out again. We had this last year for political climate and tax issues. I do get these calls from a lot of you guys out there in the field, from your clients as well. What's happening with Biden's tax plan? Well, in 2021 and 2, that's removed. We didn't have any changes to the tax code. For the fiscal year, we have 2023 budget. He is planning again the similar cap. So it would really cap $500K for each taxpayer, and I'll discuss what that looks like when we get to the equation. But consider an exchanger who has gain over $500K. Anything of gain, any amount of money that's gain over $500,000 would be now considered taxable at the full component amounts in capital gain taxation out of California. So we're still fighting for that. I don't see it happening again, but the proposal does come up year over year with Democrat presidents. That's just standard. So 1031 exchanges have been around for almost a century, over a century for a year. So we're safe. Some 1031 exchange terminology I will cover today. 1, actual receipt of funds. That's money that you're holding, right? I'm actually holding money. Boot, just like on your feet. I always say like your expensive Christian Louboutins. I've yet to buy some, but let's say boot, like on your feet. Boots are taxable, right? So we're talking anything that's not real property. Cash can be boot, or non-replaced debt can be boot. Constructive receipt is anything that maybe there's a check that's sitting in escrow. There's no assignment for the cash. So let's say you have a client that's setting up a 1031 exchange and they've already closed escrow where the burdens and benefits have transferred to the new buyer. If that happens and they have no 1031 set up, there's still money sitting in escrow. Well, I haven't touched the money. Can I set up an exchange? Unfortunately not. That is classified as constructive receipt of funds because they've already closed escrow. Now, direct deeding is just taking transaction for us in the 1031 world and taking it as an assignment from API to Mr. and Mrs. Smith exchanger. Direct deeding back and forth where we're assigned into a contract. That's really the main loophole that we need to prepare as a qualified intermediary. Exchanger, investor, and taxpayer, I'll use those interchangeably. They're the same person. Think of them as your client that's doing a 1031 exchange, your seller, or your buyer. We prepare an exchange agreement at API. So here's another one, an EA, another acronym. Our exchange agreement, as mentioned in reflection of the constructive receipt, must be placed into escrow prior to closing. All right. The exchange period, as you probably know, for those of you who want this class and are on here today, is 180 calendar days. So that's 6 months. The identification period is inclusive of that 180 days and is 45 calendar days to identify in writing to the accommodator the property or properties that your client intends to purchase. Like-kind property, this is a big one. Guys, this one can be extremely broad. You don't have to sell a single family rental and buy a single family rental. They can exchange out of a single family rental and buy a condo. They can buy a commercial building, a tenancy in common fractional ownership of a commercial building, a Delaware statutory trust, oil rights, mineral rights, a vacation home, right? So there's so many different ways that you can help list these properties for your clients and give them another avenue to find replacement property and redeploy that entire investment. As mentioned, qualified intermediary, that's asset preservation. A QI is a non-disqualified agent to the taxpayer. I'll review what that means in a little bit more detail as we get further into the class. The relinquished property is the property being sold. This term is fairly new for those seasoned realtors. Relinquished property used to be called the down leg, right? And the replacement property is the one that you're using the proceeds to wire over to for the replacement, also known as the up leg, right? So this is a brief overview of the terminology. Take it away, hold on to this. It's going to come up several times in the class today. As mentioned, we have had 1031 exchanges since 1921. Again, that's over a century of 1031 exchanges. In September, that'll be 101 years, right? So that's a lot of 1031 exchanges. Now, for those of you who aren't too familiar, what is a 1031? So IRC is an internal revenue code. 1031 is the section of the Internal Revenue Code, right? So it's an Internal Revenue Code section of the IRS tax code, right? So that's all it is. Trust me, I have so many family members and friends that say, hey, what do you do for a living? I educate on IRC section 1031. Halloween? No, definitely not Halloween. Remember, that's a specific section of the tax code. That specific section of the tax code has implemented a declaration to allow real estate investors to sell investment property, redeploy the entire investment and defer capital gains into more real estate held for an investment, okay? So all we're doing here as a qualified intermediary is acting as a bank in between the sale of investment property and purchase of more investment property. Here's another visual of how I can explain that. In a taxable sale, or what we would call a traditional sale, when you put your sign in the ground, you list a property, you know it's an investment property, and that property sells without a 1031 setup. That property, they collect actual receipt of funds, and they're facing a taxable event. In a 1031 exchange, if you have that exchange agreement set up prior to close with a qualified intermediary, the proceeds at sale go from escrow into the qualified intermediary segregated account into the replacement property escrow for purchase. So again, we're sitting here in the middle holding the funds, acting as this segregated account banking system for the exchanger taxpayer. So our goal here is for them to fully defer taxes. By doing so, we hold the money, okay? Again, once they touch proceeds, they're facing a taxable event. This is straight out of the tax code. This is the third and final statement that I'll make on defining IRC 1031 if the first couple haven't hit home for you. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade, business, or for investment. So obviously that one is a mouthful, but that's straight out of the tax code, written a long time ago that was created. And we've had all these changes and implementations and revenue procedures that have shifted the tax code. A specific one I want to make notable mention of, I do get these calls regularly, believe it or not, but in 2018, there was a tax code shift where you could exchange personal property and real property. Please note, it's strictly real property today, which benefits everyone at OCAR, right? It's anything that's held in a business or for productive use, right? So investment purposes, that's real property. Things that are excluded that we've seen, as mentioned, right? Anything that's personal property. We have stocks, bonds, notes, REITs, real estate investment trusts, excluded. A real estate investment trust is exactly that. It's a trust, a piece of paper, right, that you may own shares in, but the trust is then the owner on title, having appreciation or gain on assets, okay? Interest in a partnership. You cannot exchange your specific percentage of an interest. And other options that I've seen recently coming up are exchanging into a business. Again, that's a piece of paper, a corporation. You cannot do that. Now, capital gain taxation, which really drives the desire of why people want to do a 1031 exchange. So let's say someone bought a property for 500K and they're selling it for $1 million. Okay, that means they bought for 500 as their basis. They're selling it for $1 million. That gives me, in the math standpoint, 500K of gain. What's applied to that 500K if I do that traditional taxable sale and I don't do a 1031? Well, component one, we have depreciation recapture tax. So when clients go ahead and they file, just like everyday people like us, right? They file their taxes. They have depreciation options on investment property. So let's say that person is depreciated $100,000. $100,000, we know that 25% needs to be recaptured. So $25,000 right off the top is going to Uncle Sam. Number two, the federal capital gain tax rate is the 20% or 15% bracket. Now, again, we don't give legal tax advice. This would be specific to someone's income. All of us on this call have a different income and variation, right? Different investments. So it could be 15, could be 20. Next is the net investment income tax. That's 3.8%, also known as healthcare tax. And last but not least, the applicable state tax rate. And for those of you who are versed on this, for capital gains taxes out of the state of California, we're all the way to the high side of this little spectrum at 13.3% out of California. So when I do have that question, well, what am I paying in capital gains right off the bat, Kayla? I can't give legal tax advice, Mr. Exchanger. However, on average, you will be paying a minimum of 35% out of California. I highly recommend you A, consult with your CPA, or B, go on our website and use the capital gains tax calculator. Those are also great resources for you as realtors. Okay, using that calculator gets your hand out of the cookie jar of giving legal tax advice as well. Now, here's one last detail of the coverage of the delayed exchange, and then I'm going to pause for questions, and then we'll go into the pitfalls. So the delayed exchange structure. We start out with one, the taxpayer, your client that's selling their investment property. You list their property for sale, and they open escrow. You get them a great buyer in there, their highest offer, all cash, everything they want. And then we set a close date. Right? So now proceeds are sent by the buyer into escrow. based on the contingency removal periods, right, in zip forms in our RPA. So we get through the EMD, we get through maybe 21-day loan contingency, 17 inspection, and we're finally at the end in a traditional 30-day offer, and day of close occurs. When day of close occurs, those proceeds are then wired directly into a segregated account that we have prepared on behalf of the exchanger. We hold those proceeds within certain regulations and restrictions. Once they identify replacement property and open escrow on the replacement property, they tell us, please wire over. Here's the new escrow. Here's wiring instructions. We go ahead and do so. They've now opened escrow with the EMD, and maybe we've wired over the remaining funds. And then we direct deed title back to the client. So what we're doing here is creating an assignment for a qualified intermediary, as Asset Preservation Incorporated is, to hold the funds in between the sale of one property and the purchase of more property, both held for investment. Now, we have identification rules. Briefly, day of close of that timeline began a 45 calendar day identification period. Within those 45 days, identification is a formality created by the IRS, okay? It's saying you have a variation of 3 different rules to write down on a form and submit to your qualified intermediary. The first one is the 3 property rule, okay? They can identify up to 3 replacement properties at any combined fair market value. Number 2, the 200% rule. They can identify as many properties as they would like. However, the sum of all of the properties cannot exceed double of what they've sold. So let me say that in a different way. If they sold for $1 million and they identify or write down on their identification form submitted to us 5 properties, okay? The 5 properties added together cannot exceed 200% or double of the million. So basic math, that's $2 million, right? So the 5 properties cannot exceed more than $2 million in my example. Now, I look at this in different categories, right? The first one, the 3 property rule, is maybe for your client who wants to sell one, buy one, maybe 2 or 3, but really sell one, buy one. The 200% rule, you can think about that if they want to diversify beyond 3. I wouldn't worry about the 200% rule unless they've breached 3 properties to you and said, well, I want to buy 4, 5, 6. You can contact me. We'll review that again. That's really what I'm here for, is to walk you and your clients through a 1031 exchange anytime these questions come up. I obviously skipped over the last one. This one is really the least used rule. It's the 95% rule, and it encompasses a combination of both 3 property and 200%. Now, it allows the exchanger to use the rule of 200%, where they can ID as many properties as they would like, but also the sum, where there's no ceiling on 3 property rule. So there's no ceiling on the total of all the properties they've ID'd, and there's no limit to how many properties or the total of what they are, right? So let's say it's breached 200% and breached 3 properties. Now they're in the 95% rule. The kicker here, what is 95%? Let's say someone ID'd 10 properties. If they ID'd 10 properties, that means they have to close on 95% of what they've ID'd. So if they have 1 failed property out of that 10, they're now facing a taxable event. So again, 95% rule is not used that often unless, let's say, there's someone buying from a developer. Our national sales director usually uses this one. He's used all of them. I think same with our CEO, Javier. They like to use these tools just for experimentation. And I've had, in my 5 years with API and thousands of exchanges, maybe 1 person use that. That's a client calling in. So takeaway from this one is, remember 3 property rule. ID up to 3. If they tell you they want more, we'll talk about 200%. As mentioned, identification is a formality. Think there's a documentation. We have a piece of paper, right, that we have to write down. All right, asset preservation is the accommodator. We send it out to the client. They go ahead and write down property 123 Main Street, 456 Pennsylvania, 8, 9, 10 State Street. Those 3 properties must be written down on that form and signed and submitted to the qualified intermediary by the 45th day at midnight, okay? I want to pause here Do we have questions on the overview of what I just covered, the real basics of 1031, you know, what it looks like as far as start to finish in the transaction, maybe the identification rules, something more on 95% rule, but I just want to pause. And if anyone has a question, please write it in the Q&A. That would be fantastic. And I will pause for a second here.
I don't see anything in the Q&A just yet, Kayla.
I don't, which is great. So I'm covering it, which is good. I got all the material. Thank you.
Yeah.
Okay, so here's the meat of today, the exciting stuff, right? Talking about different areas and what occurred to you as a realtor, right? And what you see. So first and foremost, closing the sale of the relinquished property without setting up a 1031. Okay, this is a big no-no, and I mentioned that early on. Attempt to initiate the 1031 as soon as they've opened escrow. If you go wait to the last minute and they're deciding, and I know sometimes it doesn't fall on the realtor's shoulders, sometimes your client last minute will say, hey, wait, I talked to my CPA, they finally got back to me and they're closing escrow tomorrow. Can API set up an exchange in a rush deal? Absolutely. If it's 24 hours and you give me enough notice and I have a contract and a title report, I can. But remember, not all accommodators have that capability. And if you catch me at a 5 p.m. timeline on a Thursday and they're closing the next morning, that probably will not be acceptable. So be ahead of the game as a realtor, be proactive, make sure that exchange is set up, okay? We have so many of those calls that come in as mentioned that, hey, I want an exchange set up. I had one literally last week, $9 million, all cash, Laguna Beach. The realtor wasn't educated on 1031. They weren't really versed on what it looked like to set up and what an exchange agreement encompassed. So they said, hey, my client and I, we closed escrow on Friday. They want to do an exchange and this was on this Monday. I hate to tell them that, but their client's now facing $8 million in capital gains because their basis was $1 million and they held that investment property for 17 years. So that's a big no-no, and that's a terrible reflection on how you're doing business. So let's keep in mind, we have so many resources for you and your clients to set this up ahead of time. We also have links to our website if you want to just have them do it and they feel comfortable typing in their information to open an exchange online. Again, you also have me in your corner to explain constructive receipt, actual receipt of funds and what that means. Making sure that we do have it set up, not, hey, the money's still in escrow, let's get this going now. So this is what we prepare, a cooperation clause. This is the most crucial thing in setting up the exchange. The cooperation clause is key, right? We need to declare to the IRS at closing that, okay, the buyer is going to participate in this 1031 exchange. They've signed off on the assignment. They're okay with it. The seller is signed and is signing the qualified intermediary as the new holder of funds at recording, right? So I know you've probably seen this in the MLS from time to time. The first sentence here, buyer is aware, seller intends to perform an IRC section 1031 at no cost to buyer, right? That's usually the slang term of it, just at no cost to buyer casually. It's good to have this in the MLS. Again, another example today that I'm dealing with, a gal who is actually listing her mother's property up in Zephyr Cove, if any of you are familiar with Tahoe area. This is now a $3.5 million 1-1 condo in Zephyr Cove, and there was no cooperation clause coming in or listed. So the buyer is actually doing a 1031. They are doing a 1031 as the seller, and nothing was disclosed. So we're now reaching almost Friday here, and this is the close date. As Wednesday, we have 2 more days to set this up, and they're both baffled of where the funds are going and where they're coming in. Neither one was disclosed to the cooperation. And so now some people are backpedaling on the buyer side. This shouldn't be a problem in my statement. If there's a buyer coming in doing an exchange and then the seller is also doing an exchange with those sale proceeds, completely fine. Just remember, have this set up in the MLS, declare if you're writing offers and repping a 1031 buyer, they are doing an exchange. Same concept as the listing. Now, the time requirements, that 45 days, briefly, if your client in that timing, right, cannot identify replacement property by the 45th day at midnight, the money we are holding is then returned back to them on day 46. They're now facing a taxable event. On the flip side of that coin, if your client does identify replacement property on that ID form we discussed, they must close on one or all of the properties or spend all the cash on one by the end of day 180. So let's say they ID 3, okay, and now they're on day 60 and they've fallen out of escrow of all 3 properties they ID. The proceeds must remain with the 1031 exchange accommodator until the end of day 180 because their intent was to close on the property. So the IRS forces accommodator's hand to hold onto the proceeds until the end or completion of day 180 or the exchange period. So keep that in mind as well. Questions on pitfall 1 by chance of the cooperation clause? Okay. I'm diving into pitfall number 2, not understanding the requirements for full tax deferral and partial exchanges. I know you probably have this PDF that I sent out as well to Cassie early on that you should have that will correspond a little bit here. So understanding that full tax deferral, I have an equation format coming up here. Keep in mind 2 things. You need to know their buying power, right? In your strategy of becoming an exchange agent and farming anyone that's doing an investment property sale, we call that an exchange agent. You need to know 1, their basis, their gain potentially, but what are they selling for? Their list price. What are closing costs? Because in a 1031 exchange, you would take the sales price less closing costs. That's your golden egg number. That's the buying power that you as a realtor need to know if you're helping them purchase replacement property. Now, obviously, who can help you with that the most? Your rockstar escrow officers. So be sure to lean on them and help them, ask them help you, as far as a settlement statement or an estimate. So you can kind of ballpark what you're looking for because 1, they must reinvest all net proceeds and have the same or greater amount of debt on the replacement property. Those are the 2 components for full tax deferral. Now, we talked about boot early on. Let's say this person is selling for $1 million and buying for 800. You would right off the bat think that there's 200 grand left over that's taxable boot. That's not the case. Let's say closing costs are 50,000. That means that their buying power is now 950,000 because we took the million minus 50, we get to 950,000. And they're now buying a property for 800. That leaves a surplus or excess of $150,000 of boot. That could either be cash boot, or let's say they didn't want to replace a loan and $150,000 is now debt boot or debt relief that they still have to pay taxes on, also known as mortgage boot. Now, the last couple years, I've seen a lot of movement with partial exchanges where someone is selling a property with so much appreciation, so much gain, and they want some cash in their pocket. Can they do a partial exchange and maybe take, let's say, out of that $1 million sale and do that $800,000 purchase and have that $150K cash? Absolutely. They just need to know that they're paying capital gains taxes on the $150K, but only that amount. Okay, partial exchange. I think those are pretty neat because you're redeploying majority of your investment. You're taking some cash, sure, paying taxes on a little bit of it, but now you have some liquidity and you can keep growing and moving. Here's a visual of the exchange equation with different numbers. Okay, so here's a good takeaway for when you're looking at a settlement statement. Obviously, there's a lot more detail from what we see on the graph of a settlement statement. We're starting with the sales price at the top. That's value. There's a $900,000 sale. This property has a $300,000 mortgage on it or debt, right? The cost of sale or closing costs is $60,000 for this property. That leaves the 900 minus 300 minus 60, the cash or net equity of $540,000. That $540K would then be wired to that segregated account held by our company, the 1031 exchange accommodator. Obviously, the loan was paid off through escrow. The closing costs, your realtor commissions were paid, transfer, recording, title, escrow, everything paid, right? Through that closing cost of 60K. This person says, okay, Orange County Realtor, I absolutely want to find replacement property and I want to reinvest all of my net exchange proceeds of 540 and I will buy a property with the same or greater debt of that 300K. You go ahead and find them a property of $1.2 million. They've now fulfilled the component of going up, same or greater, up in value from 300 to 660,000 of debt. And we've wired over the 540 of that net equity. In this example, they have zero boot. They're paying zero in capital gains taxes, right? This one I put just straight on the screen so you could see it rather than walk through it. It's the same exact sale, just a different purchase. This person sold that $900,000 property. The 300K mortgage was paid off, 60K was paid off in closing costs, that 540 went to the accommodator. They now want to purchase a property for 700K and they get creative, okay? They say, all right, I know I'm going to pay some taxes. I want to do a partial exchange. I know I'm going to be taking boot. So they decide I'm going to talk to my lender and obtain a new loan of $260,000. So they've gone down 40 in debt relief or debt boot, which you can see in the right column, boot 40,000. The net equity, they decide actually qualified intermediary, I only want to replace 440,000 of what you're holding. Absolutely. So we wire over 440K, leaving 100,000 left in that accommodator's account that we hold for them. The total of the 40 debt, right, which is really thin air at that point, they just need to pay taxes on it, plus the 100K that goes into their pocket at closing of the replacement is a total of $140,000 in boot. So they'll be paying capital gains taxes on 140,000. I think generally we want to look at this equation and think 900, I'm buying for 7. Okay, so I know that there's going to be boot of 200K. Don't forget the closing cost factor. That changes buying power. That also changes your goal for buying power and what you need to ballpark to find replacement property for your clients. That covers number 2. Do we have questions? I can go back to that, the equation and working those numbers. Okay.
Nothing in the Q&A.
I see it now too, which is great. I pulled it up. Thank you so much for looking. So pitfall number 3, we're working our way here. Selling or exchanging in a property that is not held for investment used in a trade or business. So I covered that, like kind, right? What property is included versus excluded. Here's a visual of all of the like kind property I covered. I know that the market is shifting right now. We're all seeing that. We're still doing a high volume of 1031s. I actually have my notes here from our national sales meeting earlier this month, and we did 792 1031 exchanges last month with a total of 46 parking arrangements, which are reverse exchanges and improvement exchanges. What I'm bringing up these topics and these stats for you is because get your sign into that ground. Give your client an opportunity to maybe find something else. At least you landed this listing. I know a couple of years ago, even this last year, was so easy to just sell a property, all cash offer, 7-day close, right? It's becoming a little bit more work at this point, which is great. So educate yourself on learning these like kind properties. Maybe you have a client that doesn't know about 1031 and they think if they sell their single family rental they've owned for a decade, they don't want to buy another one. They don't want to be a property manager. There are so many creative alternative investments that I can help connect them with someone, or that they can look outside the box. Agricultural land, the oil rights, even a windmill produces energy. It has an APN attached to it. Kind of gives your client this unique perspective, right, of how to invest in their property or unload their current asset and buy something else and list with you because you're educated on 1031. Is excluded. You cannot exchange into or out of your principal or primary residence. That tax code is IRC section 121 or 121. I'm sure you're all familiar with it as the exemption, right? So single filers get 250K exemption on gain when they sell their primary. Married filers get 500K exemption on gain when they sell their primary. Uncle Sam doesn't want us to have a combination of the two, so that's why you cannot exchange into or out of the principal residence. Now, that's not to say you can't convert an exchanged property after holding it for 2 years into a primary. Okay, that's not to say you can convert a primary into an investment property, then exchange it down the road. Those are both possible scenarios. When people ask me those questions, excuse me, can I exchange into land, build on the land, hold that property for 2 years, build my dream home, and then move into it? Why not? You've improved the land, you've held the land for investment, it's appreciated, right? So there's so many different ways for you guys to get that listing and talk about, first and foremost, what do you want to do to your client? What is your end game, right? What are your goals? So I'm going to pause for a sec. It looks like we may have questions. See if I can pull it up here. The capital gain, LC, I have these, I can see them. So the capital gain is based on their purchase price, not the replacement value, right? That's correct. So the question really is capital gain, right? It's your basis. So let's say my basis is my original purchase price of 500K, and that original example where you sell it for $1 million. Your capital gain is based on that 500K gain at the time of that exchange. Now, if they exchange into a new property, let's say use the entire $1 million or $950 after closing costs, okay? And that one goes up to 1.5. And let's say they sell the 1.5 down the road. If that happens, they still have the same cost basis of $500,000. So now they have gain of $1 million. The benefit of the 1031 is continuing this rolling method, right? Where you swap till you drop. I know, super morbid, but it should be funny, right? So you exchange until you die, but you can diversify, get more rental income, have more investment assets. So that's a really neat component of the 1031. Take that 1.5 million, maybe buy 2 750s. And then when you sell 1 750, it goes back to the 500K, but it's not the entire amount. Question 2, how can a principal residence become qualified like-kind property? Thank you, Wanda, for your question. So when we're talking about a home that you bought, for instance, this is my plan currently. My husband and I bought our home. We got really lucky in 2019. We have ample gain, almost, believe it or not, 500,000 in the community we're in. And so I'm like, I want to sell it. What am I doing? Let's sell it. Let's get the exemption. But by the time it was built and completed, we've now only been in here for 1.5 years. Okay. We're waiting until February. We intend to move out of the property in February, which will be 2 years. I am then either going to A, use 121, right, for the exclusion, or B, rent it out, which is my plan as the investment one in the marriage. So we rent that out. I want to rent it for, call it 3, 5, 10 years, however long we're getting good rental income and we don't get sick of managing. If, let's say, 5 years after that, we get over it, we want to buy another property in Vail, Colorado, because I love the snow, okay? We can then 1031 exchange that property. It's an investment property. It's been used as an investment. We got to look at the timelines. It's usually rent for 2, live for 3 combination, so hold for at least 5, and then you can get a combination of the fraction of utilizing IRC 121 of the married filer, in my case, for 500K exemption, and the 1031. So exchanging a portion and an exemption for a portion. The big one right now is doing it the flip way, right? So you're doing it in reverse. They have investment property and then they're exchanging, maybe taking 2 properties, combining the sale proceeds, buying something bigger, using it as an Airbnb for 2 full calendar years as an investment, and then moving into it. Then that next year, they are filing their taxes and writing that down that they moved into their investment, and it's a primary residence. So that works. They hold that property, fantastic. If they do sell it, again, that fractional combination applies. The next question from Wanda, is there a minimum amount of time it is used for business? So 2 years. So investment property is usually 2 full calendar years and you're covered by the IRS. To do an exchange, my CPA tells me, personally on my property, again, all CPAs will give different legal tax advice for different holdings. Every holding is going to be subjective, right? What is their intent? Now, if that's the case, and let's say my CPA statement was a year and a day, hold the investment property for a year and a day, Kayla, prior to doing an exchange. That's just a straight out property, not one that I already lived in. So let's say I went and bought an investment property in Irvine and I rented it out to a student at UC Irvine, right? If I wanted to go ahead and do that before I exchange it, I would have to wait a year and a day before doing so. We say 2 years in the other timeline because that's the legal limit for living and the combination of renting. I appreciate the questions. Thank you. Moving on to pitfall 4, now that we've tackled those. Using a person who's considered disqualified or disqualified as an intermediary. So do not do that, right? These are pitfalls. Don't use a person who's disqualified. Who is disqualified? Really, when you look down here, it's anyone that's a family member, an employee, a real estate professional like yourselves, a legal tax advisor who gave legal tax advice in the last 2 years, okay? We are, by definition, a qualified intermediary, non-disqualified agent to the taxpayer. That's the exact definition. Non-dis, apparently 2 negatives make the positive, so we're qualified. Just keep in mind, qualified intermediaries have really been in use since 1973. There was a Starker case, which some of you may be familiar with. I don't want to bore you too much on private letter rulings and court cases, but this timeline in this case really created more of a need for accommodators. It's the cleanest avenue for an exchanger to do a 1031 exchange and required. Some attorney states, when I'm working with people, especially coming out of South Carolina, which is the most complex state when we're looking at attorney restrictions and closers, so they don't have escrow officers, they have attorneys. Excuse me, it gets very complex. Who can hold the money? Who can't? Best case scenario, call a qualified intermediary, focus on who they are, what they do. And that brings me to the next slide of what the qualified intermediary prepares, right? Qualified intermediary, also a facilitator. I'm sure you've heard accommodator, it's the same thing. What our goal is, and my goal, I qualify a 1031 exchange. I talk with you, I talk with your clients, I ask all the tough questions, and then I send this qualified exchange to my team of underwriters. We call them exchange counselors because they go from start to finish to that transaction with our client. They create that 1031 exchange agreement, okay? That's binding in nature to the client. That assignment is in the agreement. An assignment is a document within the agreement that states Mary Smith Exchanger is assigning asset preservation, the qualified intermediary, to be the receiver of funds at close of escrow. Crucial to every transaction. We need to create the notice of assignment. So at the closing table, every buyer needs to sign this notice of assignment, knowing that they participated in a 1031 and they were comfortable with it. It doesn't have any bearing on them legally. So it kind of removes them by signing this notice of assignment saying, hey, you want to put your money with an accommodator? I have no business with this accommodator. I'm not legally tied to anyone. Again, work as a realtor on that cooperation clause so you don't have to tackle this at, closing time on a Friday at 5 p.m. So we create the exchange account forms in detail. We send out all of the instructions, the 45-day ID period. There's all these automated updates that they get from asset preservation. They can call me, they can call my team. Maybe a question comes up that they don't have answers, shoot me a text. We're here to answer questions. So really, that's what we do here at Asset Preservation as a qualified intermediary of 31 years, believe it or not, in the business. So our goal is really to get all of these documents in place for your transaction prior to close of escrow. Any questions on pitfall 4? QIs, who's considered a QI? Fantastic. Okay, here's pitfall number 5, not consulting with the CPA tax advisor before closing on the sale of the relinquished property. So my investments are going to be different than your investments, right? It's just standard. If I maybe, let's say I bought that $500,000 property and I improved it $150K, that bumps my basis up. My adjusted cost basis is now $650K, and maybe I'm selling that property for $700,000. That only gives me $50K of gain, right? What about closing costs? That's going to shrink my gain. So I highly recommend the client talks to their legal tax advisor. We don't really know what they've filed. We don't know what improvements they've put into the property. We don't know if they lived in it. In that original example, I think a couple of pitfalls back that we covered, do they get an exclusion? Do they not? Is there someone that was maybe living there that was living rent-free and they were living there? So a bunch of different variations and possibilities that are inclusive of this conversation that they'll have with their CPA that sometimes, and I'm sure we've all felt it, but sometimes the client gets uncomfortable discussing with you as their realtor, even though you need the information, and me as their qualified intermediary. So I'm right there with you. Just make sure that they absolutely seek legal tax advice. And some of the questions when they come to me, and same with realtors, when you guys come to me, I can't answer them. Do I know the answers a lot of the time? Yes. Can I give the response? No, I legally cannot do that. So please, let's not put anyone in that situation, and let's get our clients the best information that they deserve. Number 6, the pitfall, not handling partnerships or LLC issues properly. Okay. Again, you as a realtor should consult with your title representative, verify vesting prior to accepting an offer, right? This is a big deal for me and the transaction I deal with, and I'm sure title and escrow. When you're maybe signing that you're working, let's say you're working with a listing, right? And a buyer comes in and it's just this blank offer, right? Standard. So the blank offer comes in, you don't have to fill it out. Make sure that when you fill out your client's seller information, it reflects mirror image of what that deed states or the prelim, right? So be ahead of the game and know how your client holds that property, especially if they're doing a 1031. If, let's say, they have it in an LLC, is the LLC regarded? Is it disregarded? Do we know the answer to that? I can ask those tough questions where we have a disregarded LLC, is meaning it's disregarded, it's irrelevant. So it's your taxpayer's individual name. Is it regarded? Maybe they don't know. They need to talk to their CPA about that as well. It also creates more work for you if maybe your Mary Smith exchanger seller says it's Mary Smith on title, and then you go to pull it and it's this fancy long-term trust. You know how have to have an addendum, right? To go ahead and be placed into your contract that's signed by the buyer, signed by the seller, that now changes it to the trust. So we absolutely need that upon recording for everything to match, okay? If we have LLCs or partners where, let's say, there's 5 people selling a fourplex that you're listing, and 3 partners want to do an exchange under the regarded LLC and 2 do not. If that scenario occurs, there's a drop and swap and a swap and drop. These get complex. So we need to have that LLC, the entity that sells, needs to buy. So when a partner removes themselves or wants to get a cut or their shares out, distribution of cash in an LLC income. So we have unique ways to figure this out for them ahead of the game. It's definitely crucial that we see title as soon as you can get it, for your sake, for their sake, for escrow's sake, just to keep it professional and smooth moving forward. Now, again, another takeaway, the entity that sells needs to be the entity that acquires. Oh, well, I want to buy this property and put my son on title. The entity that sells is the entity that acquires, unless, let's say, they're doing a tenant in common and switching it with a different percentage. But number one, again, takeaway, sell and buy, same person. Moving on to number 7, I don't see questions just yet. Here's a pitfall: not evaluating the entire exchange transaction on both sides of the exchange. In my opinion, how I got going in 1031s, I asked those questions in my first 5 years of being a realtor. I started having so many investment clients because I was asking, well, what do you intend to do with your funds? What do you want to do with the money at the sale? Oh, well, we're just going to take it. We shouldn't be hit with that much in capital gains. Well, reviewing the capital gains at a minimum of 35% out of the state of California, let's talk about what you can buy. That gives you as a realtor the opportunity to put your hero cape on, tie it up nice and neat, rescue a deal, have them list, help them buy something else potentially, or get a referral fee from someone maybe in another state. Because remember, IRC, Internal Revenue Code, is a federal tax code. Anywhere in the United States can be exchanged, right? So the bullet points you see on the board, I've kind of covered in my own terminology, but really we're focusing on looking at the numbers as well. When you sell a property, which we used to have traditionally, right, as the ceiling that people would lowball, we're now all seeing that decrease a little bit. I don't know about you, but I've seen all of these Zillow and Realtor.com, I keep up and it's price decrease, decrease. So we're all kind of holding our breath. For you to get ahead of the game and know what their directive is and what they want to buy, maybe keep an eye on that dream property that they had in mind and stay up to date with it and know that they have that investment property and that they can exchange into it. Now, I mentioned exchanging the entities, just keep them cohesive, right? This is the same for being ahead of the game of Pitfall 7, right? Evaluating the entire transaction. So it also coincides with Pitfall 6, knowing who the tax owner is, being ahead of the game. It doesn't look good when you have to backtrack and then change documentation. I had one, I think last month, that there was about 7 different addendums because they weren't getting title right. So, and that was, closing, I think it was 4 p.m. on the day of close, and they had to push close. So just be ahead of the game on that one for moving forward. I have a question here, Lillian. I see, what is escalation clauses? Yes, in that last slide, I'm sure you may or may not have seen, but when the market was out of control, trying to go back here, there we go. When the market was out of control, right? I'll give you a personal example. My family did a 1031 exchange out of San Marcos and an investment property my father, my brother, and I owned, and my mother, of course, don't leave her out. We did an exchange in the property. There was about 10 offers that came in within day 1 Saturday, right? The property was listed at 775. There was an escalation clause in an offer, right? That said the escalation, their offer was 800,000, but would escalate all the way up to 850 to beat out any other offer. That to me kind of sets a rift in the market, but I'll tell you what, we took that offer. So that's what the escalation clause was in that last screen. Thank you for the question. Rachel has a question. Does title held on relinquished property need to match title held on replacement property? Yes, ma'am, it absolutely does. Now, if we're looking at a couple variations of title, say you have a client that is Mark and Mary Smith family trust, living family trust, and then they're buying as Mark and Mary Smith. That works. It's the same taxpayer. Would we like to see it be the same exact way? Absolutely. It keeps it clean, right? As mentioned, there's a regarded and disregarded LLC. I ask those questions, so don't feel intimidated about those questions. I can ask them, hey, is the LLC regarded or disregarded? Well, I don't know. Well, does it file its own tax return? Do you have its own bank account? Well, maybe let me talk to my CPA, right? Those are usually the follow-up questions. But if it is disregarded, for instance, I have a gentleman right now that's a disregarded, I think it's called Capital Hub LLC, that's doing an exchange, but he's the sole member and he's buying the replacement property with his name on it in their family trust. That works because it's the same taxpayer. Okay. The problem occurs when we see Capital Hub LLC that's regarded, say there's 10 members of that, it files its own tax return, it has its own bank account statement, everything, right? So the income funnels to this account, then is distributed to the 10 members. The issue arises when this person does an exchange and now they're buying as 10 individual names. You're raising a huge red flag with the IRS. The IRS wants this 1031 exchange, this tax deferred exchange, to be advantageous of the person who owns the real property. And that's the person on title. If you're switching from an LLC to an individual that's regarded, and an individual is obviously regarded as a heartbeat, its own person. If you're doing that, you're now having property tax basis shifting, which is illegal. So that's why we like to see that. Let me see if I can click through here. There we go. Okay, make sure I got through the questions. I did, fantastic. Pitfall number 8, what to avoid. Let's avoid engaging in related party transactions. What does that mean? Let's say that, I mentioned born and raised in a family of real estate investors. Let's say I'm buying a property from my father, Mike, and I say, Mike, Dad, I'm gonna buy a property from you. He's selling an investment property. And he goes, okay, but I don't want to exchange. And I'm exchanging into it. I go ahead, I exchange into it. He doesn't do an exchange. He ends up with all this cash. Inheritance laws state that he can give me 15 grand of any cash that he has tax-free every year per parent, per kid, right? So the issue here is this bottom bullet point: exchangers should not end up with cash in related party transactions. They get very, very sticky. If the scenario occurred where Kayla Ferking exchanged into Mike Franklin's property and he exchanged into more property, that would work. No one's ending up with cash. Just be very careful with these and ask those questions. If maybe, oh, my son's buying my property, I'm doing an exchange. Great. Is your son also doing an exchange? We just need to get ahead of this. And again, legal tax advice, you know the drill. Make sure that they talk to their CPA. Make sure that the entity isn't maybe let's say Kayla and Mike on title, and then I'm exchanging into property I already own. I cannot exchange into property I already own. That's again a problem. If I'm buying a percentage interest in property, that could work. So creative options here, but please, please, please take away, exchangers can't end up with cash when they're doing exchanges with related parties. We see this a lot in Southern California, especially people that are investment legacy families, that they just want to keep owning property and swapping and holding for value, and other people want to get out and maybe buy something else. I'm going to move on to the last pitfall. Here is 9. Pitfall 9, not understanding reverse exchange parking arrangement transactions. So these can get very complex. I know that there are other classes on parking arrangements. I hold my own personal classes. I am able to come into your brokerages to offer my services and go over more complex exchanges and what these look like. Takeaway from today: what is a reverse exchange? Purchasing the replacement property before the sale of the relinquished property. There's a lot of moving parts to this. They are a lot more complex, but with a sophisticated accommodator like the one I work for, they shouldn't be stressful for your client. What happens is your client has to come up with the cash and or cash debt combination. So get a loan. They find the property that goes up this weekend. They want it now. So they have to buy it first. They open escrow, 30-day escrow, let's call it. They contact us. Takes us 2 to 3 weeks to set up a brand new LLC and also work with our attorneys to create an engagement letter. When we have that prepared, at closing, we then park, just like parking a car, it sits there. So we park that LLC title on the property. Day of close begins 180 calendar days, so the exchange period in reverse, for them to sell the property they intend to relinquish. Once they sell the relinquished property, they can replenish their savings account, pay off the loan, and then we direct deed title back to them that was originally the LLC on the replacement, or they can take assignment of it, right? They can say, actually, I want to keep that LLC. I'll do a disregarded LLC on that property to Kayla Ferking, okay? Improvement exchanges. There are a lot of properties out there that need a lot of love, right? In an improvement exchange, just like a delayed exchange, you take the sale proceeds, they sit in that segregated account held by the accommodator. Let's say they identify property in their 45-day window that needs a new roof. So in their identification property, 123 Main Street, plus $50,000 for a new roof, plus solar, plus new electrical wiring, plus new flooring, gives me the entire purchase price for a replacement property of $1 million. They've opened escrow with the replacement. Oops. They've opened escrow with the replacement property, right? And let's say there's still that surplus of maybe 250K cash. They can use that 250K cash to actually improve on what they ID'd, that roof, the solar, right? All the things that they've added to actually have capital improvements to the real property. However, they have 180 days, the entire exchange period, to complete the improvements. So think of the improvement exchange as really using all of your funds to not take a hit and pay capital gains and improving a property that maybe needs some of that love, right? So this is a great tool for your clients as well. Also consider it in a way, almost a construction loan. We're just holding it as their bank and they're drawing from it to strictly improve upon real property. You cannot buy appliances with it, nothing that's movable. And then reverse improvement combines the two, buying the replacement, putting it with the LLC, then the relinquished sells, the proceeds go in here, then we can start drawing on it with an additional 100, right? So 180 days, excuse me, to go ahead and improve the property. So that one's my favorite. You find the property you want first, then when the relinquished sells, you can use some of that money to improve that property. So a lot of cool tools that are out there for your clients, and even yourself if you're an investor. So you can buy the property first if that's the one you want, and maybe it's a highly desired neighborhood and you've been waiting for that one to come up on the market. So remember, if your client wants something now, but I have to sell this one first, we can do a reverse exchange. They can get both, best of both worlds, right? Now, just as an overview, highlights of the delayed exchange, just consult with a qualified intermediary, ask the questions. You can call me before. I do this a lot. I'd rather consult with your client. We can do a conference call. We can meet in person. Again, I can come into the office, pitch, present, whatever you need me to do. I'm here for you. Consider me part of your team. Just ensure that that sale contract is assignable. Again, we create that assignment. You create a cooperation clause. And then we need to have the exchange agreement prepared again prior to close. We understand the ID period, 45 calendar days. You cannot change property UID after the 45th day at midnight. Okay, you can change those properties if it's within the 45 days. And again, you have to close on the replacement property by the 180th calendar day. When you are researching QIs, trust me, I know there's so many people to choose out there, and I'm not here to be salesy to you. I'm here to tell you I've worked with other accommodators when I was in your shoes and I didn't know where the money was going. So that's a really good question. Where's my client's money going? Okay, just ask the tough questions. You're there as your fiduciary responsibility for your client. At API, we're backed by a national title company. So we're backed by a title insurance company. We create segregated accounts for all of our exchangers. Okay, and we've done over now, gosh, 250,000 plus exchanges in our 31 years of business. So it's good to have security of funds. You don't want that $1 million going off into, I don't know, another country. There was a scenario in San Diego 15 years ago that a gentleman started a brand new QI. All these new people on social media starting a new QI. Where's the money going? They can't even explain the insurance policy. So ask those questions. That guy decided all those funds were going into the same account and ran off with the money. So a little scary to me. Just be sure to ask those accounts or ask those questions about the accounts. Are they segregated? Do they have a qualified trust account? Is there bond coverage, fidelity coverage? What is it, right? Ask the tough questions, interview that person. You know, it doesn't have to be us. There's 2 other national accommodators that I truly trust. I've worked for another one. And there's other people out there. So work with who you trust, who you know, and really thank you for your time overall. You know, last but not least, our API advantage, we have over 100 years of experience. on our team. Our contract was created by Lou Weller, who is the 1031 God guru in our industry. So he is there to answer, help, provide. We have that security of funds backed by a national title insurance company. If you want to know the company, you can let me know. I work with all title representatives. And last but not least, a big takeaway for you on a sales perspective, mailers and materials. You guys, I spent so much time focusing on creating marketing, hiring people. We have over 180 of these 5 reasons to exchange mailers that you can go ahead, download, and look at the bottom left corner of this PDF. Compliments of, go ahead, put your name in there, your picture, send that out via email. Send it out in a mailer, have it with you at a listing agreement. And again, and this is 170, there's over 180 now. We have a great marketing team. I need to update that. So go ahead, use these and use our company as a resource. Sorry, my Apple Watch keeps talking to me here. YouTube, we have 1031 Exchanges is really our platform. We're lucky. Again, great marketing team. We have Facebook, LinkedIn, Twitter. And then my contact information is here. Take a picture of it if you want, send me an email, text me, not at that number. I can give you my direct cell phone. Actually, on this call, I will tell you. It is 949-308 as well, 3089543. And keep in mind, our offices, I should say this before I get to questions, our offices are open Monday through Friday. I'm usually working 7 to 6. They're open 8 to 5, just like a bank. So we're not open on weekends. If you do catch me with my work phone, that cell phone number I gave you, which is my work cell phone on the weekends, I'll do my best to answer your questions when I know you're making offers. Last questions I have here. If anyone has any, throw them in the question box now. I want to get to these before letting you go about your day and hit the ground running with sales. We have Michelle. Hi, Michelle. She says, after completed a 1031 exchange of a rental property, how long do you have to rent it out before changing it into a principal residence? So that timeline, day of close of the replacement in the 1031, 2 full calendar years. Then you can change it into a primary and live in it. You're limited to when you sell that if you do convert it to a primary. Okay, so you exchange, you hold it for 2 as an investment, live in it for 3, then you can sell it after 5. All right. I hope that one covered. Any other questions? I feel like I'm way ahead of time. I'm way ahead of time, which is good. I feel like I covered it. Let's see, I have stuff coming up in the chat. Cell number again. Yes. Verbally, it is 949. I'll type it in again. 949-308-9543. So I appreciate your time and commitment today. I know it's tough, again, summer, getting on these Zooms, but thank you for sharing your afternoon with me today. I know we're hosting another, I think the similar format of what I just covered. I may be adding more strategies because I do have a little bit more time for next time. But if you have an immediate question, let me know. I'm here for you. Thanks so much all. I appreciate it. Cassie and Elsie, thank you for having me. Orange County Association of Realtors.